Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Join the community, click subscribe, let's ride this commodity bull market up together. I was listening to Lacey Hunt, I was listening to another guy talk about deflation, and I mean, obviously they're making some points. They referred to two areas that I'm going to talk about, two time frames. They talked about a recession, kind of deflationary period. And one thing that I think I differ on is I don't agree with the conditions and where they basically pointed. So he said that this is what happened after the 82, this is what happened after this, but the conditions were different during those time frames than the conditions that we had today. And I'm going to go over that and show you guys what the differences are and conditions are. I am very much in the camp that things are prosperous. People are prosperous. Plants, when you grow them, are prosperous based off the conditions that they are subject to. So when you think about things in life, you think about things and how people, you could have a very smart person flunk out of college, and then you'd say, well, they weren't very smart. That would be the comment that someone would make. Someone on YouTube would create a YouTube clip and they'd say, this person's not very smart, he flunked out of college, therefore, this person isn't smart. And then I look at it and I say, okay, let's actually look at the details. This person growing up was playing with electronics. He was taking apart electronics, putting them back together, and his parents decided that he should go into an economics degree. And he didn't like economics at all and flunked out of college, even though the kid or the person could be a genius. It's just the conditions that this person was subject to, he didn't want to put the effort into it. He didn't care about it. He didn't value an economics degree that maybe his parents forced him to go into. So it's not really that he's a stupid person. He just doesn't care about what he went into and what he was forced to do. So in a battle against his parents, he said, I'm going to flunk out because I reject what you're wanting me to do. So that's the background story. But in the beginning, everybody said, oh, it's just a direct effect. Flunk, dumb. You have to look at the background. You have to look at the market conditions. You have to look at everything that it's subject to. And if you want to be a good manager, it's the same way if you want to be a good manager in work. And I know I'm going a little bit off point here, but if you want to be good and have people prosper, it's about alignment. It's about alignment to things that they care about, and it's about alignment to a vision that they want to go. If they want to go this direction, you don't say, no, your vision sucks and you shouldn't go that direction. You need to go this direction. You think they're going to be successful in a direction they don't want to go. I mean, that's kind of where I'm heading at. So when you look at basically investments, you have to look at the underlying market conditions because investments want to go where they want to go. People are going to put money in certain areas when the market conditions are ripe for those conditions. So I'm looking at the market conditions here. Some of you have been on the channel, you've seen this before. I'm going to go over it again and give maybe a different viewpoint or paradigm and talk about maybe some of these other guys and the differences between their, they went in and gave specific examples of time frames. And I'm going to tell you that the market conditions during those time frames are different in every scenario. And I'm going to show you why I think that. So here we go. This is the inflation deflation debate. This is also why I invest in some of these areas and the alignment of the market conditions and valuations. So first, you're going to lose me. And I'm going to go into the commodity index versus the S&P 500 ratio. Obviously, if it's in a green circle, it means commodities are cheap in the green circles. They're expensive, and stocks are cheap in the red circles. We cycle from undervalued to overvalued, back to undervalued to overvalued, back to undervalued. We are at the cheapest spot in history. I put these blue arrows indicating that it was cheap. Blue arrow, blue arrow, blue arrow. Now I'm going to transfer these blue arrows to the next chart, signaling where they align in the housing starts. So every time we have this undervaluation, it's aligning right where we have a housing market boom. So what we're looking at is the housing starts. This is where new homes are being built. The blue line is the average that we want per year. And the real estate cycle just cycles about that average back and forth. Now, I transferred these blue arrows every single time we had a commodities boom. Commodities boom, commodities boom, and we're starting another green circle where a commodities boom is going to end up, where the housing starts are entering an expansionary phase of real estate. Now, I can tie this chart, this housing starts, to the M2 money supply, and it directly correlates, which means that housing starts and loans against the housing starts increases the M2 money supply, and then a year or two later, inflation comes. Inflation is just a lagging indicator. It lags by a year or two. So we've got total alignment there. Now, I put stars on this chart of recessions. Dark line, dark line, dark line recessions. Right before every recession, we had a decline in land values and real estate, and housing starts went down. Down, recession. Down, recession. Down, recession. Down, recession. Down, recession. Down, recession. We had one recession that was not the early 2000s, 2001 dot-com bubble. That's the only one we had that was a recession, but we didn't really have a big recession because the housing market is what pulled through it. Then we got a recession here at the end of 08-09, which was caused, these are all caused, every single one of these recessions is caused by declining real estate land values and a decline in the housing starts. They all have it right here. Look at that. Down recession, and so on. Now, what's the difference here? He chose 82 as in one of his clips. 82, we had a huge recession collapse in real estate. Real estate was the driver of this recession. We had two back-to-back ones. And then when we came out of it, we had to go into this recovery phase for a while. And it wasn't a huge blowout recovery. Commodities were in a kind of a lull. This is back in the early 80s. And if we were to go back, the early 80s was in this time frame in here. Commodities were kind of from an overvalued state coming down. Now, he also referred to the last crash in 08-09, which was also driven by a massive amount of inventory of homes. Big recession coming on down, and we had a long, huge time in a recovery phase of real estate because of all the foreclosures and all of the homes that we had built up here in this hyper supply phase in the last expansionary phase of real estate cycle. But here's the major difference here. They're calling this a recession, but it was a recession that was brought on by an external factor. We shut the economy down for 2 months and stopped it. Here's the difference. We're in the middle of an expansionary phase of real estate. How many recessions did we have in history in an expansionary phase of real estate? Let me tell you, we've had zero. None. Zero. Zilch. We've had inflation under expansionary phases of real estate. Zero recessions. None. Well, we shut down in the middle of an expansionary phase of real estate. What do you think the chances are of another recession coming? It's probably not going to come from real estate. And if we've had zero instances in history of increasing land values, residential land values, and recession, what do you think the likelihood is of a full-blown, deflation to happen? We've had one recession here of the dot-com bubble, but that was a recession contained to stocks. It wasn't a recession that affected the real estate market. I am probably proposing that we're going to see something close to this dot-com bubble happen again. And this is how it's going to play out. You're going to get into this expansionary phase. You're going to have interest rates rise, and it's going to put a lot of pressure on the technology companies with large multiple PE ratios. A tech bubble is what we're in. And if we continue to move up in this expansionary phase, people like Cathie Wood are not going to be happy, because her stocks don't work in that type of environment. Here is the S&P 500 to CRB index looked at a different way as it comes on up. Stocks outperform, commodities outperform. Stocks outperform, commodities outperform. And I think we're coming to a point where stocks have been so out of whack to the upside here in this ratio that we could reverse and head way lower. I don't know how low it's going to go. Maybe we draw a trend line through here and it only comes back to here. Maybe it goes all the way back to 0.5. I don't have that answer for you. I don't know how large this commodity boom is going to be, but I think it's going to be massive. It's going to turn a lot of heads. It's gonna disrupt a lot of people's paradigms. Here's the new chart updated. Notice here that we're all the way up at 16.2. We're at 20 right now. It's never been this out of whack. And look what we did. We broke the uptrend. We broke this uptrend and we back tested here, and we're probably going to head lower. We're trying to break out and do a new downtrend reversal. It's called a Trader Vic 123 reversal. We're trying to do it right now. We break down and we have a new downtrend. Well, we'll see how low this thing goes. I think we're going to go all the way back down to that 3 level possibly. That could be a 6x on commodities. That's huge. That is absolutely huge. Now here's emerging markets, just to show you kind of the last bull market from 98, 99 was the bottom. You bought in, you get this nice little pattern for a couple years, and then it just blew higher. This is emerging markets performance. Emerging markets they're quite volatile. And I think they're going to do incredibly well going forward. I am definitely diversifying and loading up in emerging markets because they have the demographics. And if the dollar becomes weak over the next however many years, it's going to be a tailwind for them. Here's a real-time chart of emerging markets. And I think this looks absolutely fantastic. The projected move is the move from here to here on top of here, which is way higher. It's off the chart, obviously. We broke out, and then it usually hangs out for a little bit. It almost always does stuff like this, or it comes back and back tests. I don't know if we're going to go all the way back and back test, but it's hanging out, and I've been accumulating in here in my 401k. Here's zoomed in on the right-hand side. We are in this chart pattern, moving on sideways. It's hugging the upper side here. Usually when you hug the upper side, it wants to break to the upside eventually. They try to push it down, or somebody did, the sellers, and then we're coming back up. We break this, I think it's game on. Now looking at gold, this is a long-term price of gold. I don't see any type of bearishness in this pattern. It's a clear cup and handle pattern that we've got here. I think if we break to the upside here, this is going to be a nice game on move to the upside. Remember, expansionary phase of real estate was this. Expansionary phase of real estate was this. We didn't get that expansion yet, and we were overvalued at this point. Expansionary phase of real estate all the way through here. We had the fall off, and then they usually has a little bit more momentum after commodities pull back for another 2 or 3 years. It happened here as well. We are just starting an expansionary phase of real estate. It's like we're right here on this move going up, and we're right here on this move going up. We are just starting this move. This was a recovery phase from 2016 onward. Real estate prices started to heat up a little bit. 2016 is kind of this bottom right in here. We started to move up, and I think we're going to see the whole enchilada here. This is going to move. Be patient. Here's the platinum price. 2 big consolidation periods, right? Here's our other consolidation period. We are still in it. We're about, I think, to break out very soon. We broke this downtrend line here to the upside. Now we're working on this bigger pattern. We break this bigger pattern, it is so game on. Platinum and copper are the 2 things that signal that inflation's coming. And if we have inflation and people, all that has to happen is a paradigm shift in the way people think and what they want to do with their money. And if we can get some people, if some people start realizing that inflation's going to stick around, what these charts are suggesting is that it is, I think we're going to launch. It'll be a nice launch. Here's silver price. This thing looks fantastic. We're coming up with higher lows. Everyone knows higher lows means it's going to step up into that resistance line. Now this pattern is massive, absolutely massive. And when we break this, and I'm gonna do a price projection here and show you how ridiculous this pattern size is. The projection move is the entry point to this pattern, and it's way off it's probably $300 or something like that. I can't even go all the way up there. It's way off the chart. 100 won't even be a stopping point. And I think it's very possible to do all this. Now, what are the chances that platinum's aligning to do this, silver's aligning to do this, and gold's aligning to do this? And gold has a cup and handle pattern, silver has a massive cup and handle pattern, and platinum's putting in a pattern as well. What's the chances of this all happening? That they're all putting in these patterns and have them all fail? I don't think so. I think they'll be delayed, but I don't think they'll fail. Now, here's the copper price. We've got the copper price here, and this is another indicator that the economy is doing certain things here. We broke out of this pattern to the upside, copper, and it ran all the way to its highs, basically, and it's pausing there for a little bit before it moves higher. But this is signaling that we have a commodity boom coming. All of these charts are signaling a commodity boom. Now, here's the dollar to franc ratio, the Swiss franc. The last commodity bull market from 2000 had a declining dollar. So the dollar was declining in relationship to the franc. So it declined all the way to the bottom of about 2008. And then we had a couple more years to 2011. This is where our precious metals bottomed, was right here. Then it reversed, and we went into this period of sideways consolidation. And then we broke to the downside of this, signaling another downward move. If the dollar to franc ratio moving downward signals a commodity boom, well, what is it signaling right now? A commodity boom and inflation. The dollar is weaker than the franc, the Swiss franc. Everything's aligning here. Copper to gold ratio on a very long-term basis. We broke from the 1971 all the way out and down. You draw the height of this move is the projected move. I mean, this is going to be big. It's going to be massive. Copper is going to do incredibly well, I think, on a long-term perspective. What about the copper price versus the China Li Keqiang index? Keqiang? I don't know, however you say it. What it is that the copper price is a prelude to the move of a lot of these emerging market countries that have different currencies. So when copper price moves up, copper's a leader to this move. Copper is blowing up to the upside. What do you think emerging markets is going to do? It's going to go way up. It's going to follow the price of copper. So we need to be diligent and watch what copper's doing. Copper is breaking out against gold and ready to move. That's what it's doing. Now, here's U.S. inflation, and here's the gold spot price. I wanted to get this out of the way, too. The gold spot price led the U.S. CPI urban consumers. Now, inflation, the CPI is all jacked up, but gold was the leader here. Gold led this. It came up, and then inflation would come up. So I think gold's going to take off here shortly. Copper and gold price. Here is red's the copper price. Gold is the gold price. And then we've got the copper to gold ratio. Copper takes off. Gold kind of lags a little bit. Comes all the way down. Copper took off first. Gold came second. And then gold outperformed during this period in here. And the copper to gold ratio. Now, I don't have much else to say here, but let's look at some of these price charts on the short term. Gold looks like it is firming up. We came on down. We threw a bearish or bullish engulfing here. We were coming on down. I was seeing what's going to happen here. We've got a lot of momentum coming down here. Now, this momentum on a regular looking chart, if it's unmanipulated, would have a lot of downside momentum here. Now, if this move here was manipulated, maybe that momentum doesn't exist. And maybe we'll just float on higher here. It's a possibility. But this doesn't look too bad. I'm seeing a lot of kind of up days, but the small little down days, this is a little small down day. Not much momentum left. So this could move on higher here. Same with silver. If this was a manipulation day, what you'd see is this sideways movement. I don't see the sellers stepping in here. I don't see them necessarily stepping in. It took a little bit of time for them to step in, but we'll see what happens here. Kind of a sideways action. And platinum's throwing in a bullish engulfing right here, which means it probably wants to go higher. It's firming up quite nicely. So this is what I've been looking at. I was listening to the deflation side, trying to get a grasp on what they're looking at, trying to understand. But I just, for some reason, the way that I'm seeing it is I'm looking at different market conditions. So they bring up an example, but the example was when housing market crashed. It wasn't in the middle of an expansionary phase where we're short a bunch of homes. So I don't know if they know that. I don't know if they've done this correlation. I'm not exactly sure. I'm trying to better understand the deflation camp, but I'm still in the inflation camp. I still see the market conditions and all the alignment with every single chart I threw up here. It's aligning for a move higher. Now, could we have a short-term little blip? That's definitely possible. Short-term blip could definitely be a little deflationary scare if something did exist out there, but I don't think it would be a structural, it wouldn't ruin us structurally. We would just ride through it. Maybe we go down 30, 40% or something, and then we have to ride it back up. At what point does that 30% begin? I don't know. I mean, do we go up a 2x and then crash a little bit and then take off? I don't know. If there is a crash, even if there is a deflationary scare, like a COVID variant or something like that, that could be a possibility. And I don't know if anyone would know that, but I don't think the markets would react the same. It could be a positive. We could shut down for a teeny bit, and then all of a sudden people are like, they're going to print so much, it's going to be unbelievable. And maybe everything rockets higher. And again, the first time we went through COVID, everyone was scared because we didn't know what COVID really was. Everyone was scared, dude, this could kill us. We didn't know the outcome or the ramifications of how lethal this could be. In my opinion, I'm not afraid of COVID. I already had COVID, tested positive, had to do all that. Wasn't that big of a deal. In fact, I thought it was less of a problem for me than actual the flu is, because I don't like throwing up. I hate throwing up. So I'd rather have COVID than the flu. So then if you look at this, I think people know kind of the outcome. They're way more comfortable with COVID than we were before. I don't think it's going to be as disastrous as before if something does happen with the COVID front, unless it starts really getting lethal. But viruses don't want to kill the host. It wants to live and migrate to other hosts. So I would think that the variants would be less harmful to humans than more harmful. But that's I'm not an expert in that field. That is a pure opinion of mine. So hopefully this gets you a little more confident. Hopefully it gets you more data on the market conditions that are underlying underneath the thesis that I have on the channel. I'm not trying to necessarily prove to everyone that this is necessarily right, but it's the alignment that I want you guys to see. The alignment between all these different assets, how they're all lining up for big bull market runs in a lot of these commodities and ratios, and even in some of these emerging markets or other currency markets. And I'm playing all of it. I'm playing the other markets. I have money invested in those. I have money invested in commodities. I have money invest in precious metals, physical metals, mining companies, royalty companies. I have it everywhere. So I'm ready for this type of move. Now, I haven't seen this alignment ever in my history, and this many large ratio charts and price charts all breaking to the one side. And that's why I'm kind of positioned so heavily for that move. Now, if it moves in the opposite direction, it's gonna hurt. It will hurt. So keep that in mind. I am not as positioned for a deflationary move. I'm more positioned under an inflationary move. And if we get deflation, I don't think it'll be long lasting. I'm going to have to ride through a very painful short-term move before getting to, we'll call it the other side, where things are all green and and the accounts start adding zeros. At least that's the hope. If you guys like this content, give me a thumbs up. Thanks for listening. This is Finding Value.